I want to move on and talk about trading range reversals. Trading range, you want to buy low, sell high, and scalp. That's an acronym: buy low, sell high, scalp. You want to buy low. The market has a lot of trading range price action here, and went up and went down and went up and down and up and down. Trading range price action. And this is near the bottom of that price action, so traders are looking to buy low. If you have a strong bear breakout and follow through, rather than buying the first reversal up, it's better to take the second reversal up. And the same here, strong bull breakout. Should you sell this low? Probably not. But if the bulls fail again, then take a second entry short, especially below a bear bar. So you want to sell high in the top third, buy low in the bottom third. You also should be scalping, because look what happens. If you buy here, it goes down. If you sell here, it goes up. The one thing you're sure of is that the market's not going to go very far, and therefore you have to scalp. So you sell here, and you're going to be looking to take profits either at a fixed number of ticks or pips on the way down, or on a reversal up, especially above a bull bar. If you buy here, you got to be looking to exit. Maybe here, a big low 2 short, low 1, pull back low 2, or you can argue strong enough bull breakout will get a second leg up, then probably get out either below here or below that bear bar. A very important point when you're trading reversals in trading ranges, you have to make sure that the market is in a trading range and has not converted into a trend. Also, ideally, you want your reward to be at least as big as your risk. Look at this. Clearly a trading range. But then what took place here? A strong bull breakout, a very big bull bar. Unlike all the bars in here, we got a very big bull bar, closing not only above the high of the prior bar, but of the high of the past 30 or 40 bars. And then we have a follow-through bar, a bull bar after the bull breakout bar. The odds are we're going to have at least a second leg up. This tells you that the odds are the market no longer is in a trading range, and it now is a bull trend. This is a trading range, clearly. Repeated reversals, the lack of consecutive trend bars up or down all through here, the lack of consecutive big trend bars. The range is fairly broad. Went up for 10 or 15 bars, down for 20 or 30 bars, 40 bars. And when the range is broad like this, you can swing as well as scalp. We have a micro double bottom here. We gap down, we went up, we went down again, we're going up. So you can buy that for a swing or a scalp. And the same over here. We're breaking below this low, but we're reversing up, micro double bottom, and the market's stalling. So we might get a swing up. And then another test of the bottom, possible double bottom, and then a small double bottom nested within a bigger double bottom. So that would be a buy. You can enter with stop orders, enter just above the high of the signal bar, and either scalp or swing. And the same is true at the top. We have a buy climax, bad follow through, failed breakout above the range. Okay to sell that, certainly for a swing. Here we got one attempt to go up that failed, another attempt to go up that failed. So we have a second entry short and around a 50% pullback of this trend. A little bit more, but about a 50% pullback. So that's a sell. And then we have two attempts to break above the top of the range, both with bear bars. A second entry short at the top of a trading range. That's a pretty reliable bet, especially with a good sell signal bar. Place an order to sell. As soon as that bear bar closes, place an order to sell on a stop just below the low of that bar, and you get filled over here on your entry bar. More experienced traders will enter with limit orders as well. For example, here we have 4 or 5 bull bars and a pretty good reversal. They'll bet the first attempt to go down will fail, So they'll place a buy limit order at the low of that bar. Here, they see that when the market fell below this bar, it went up. Below this bar, it went up. So limit order bulls are making money. So bulls placing limit orders at the prior low are making scalps. When you're near the bottom of the range, what's going to happen when you break below this bar? Probably it's going to go up. So bulls will buy below that bar. Here is a low one short at the bottom of a trading range and the bottom of a weak bear channel, and it has a doji sell signal bar. Bulls will buy it, betting that there'll be more buyers than sellers below the low of that bar. The same is true at the top. Fairly weak rally, small bars, prominent tails, a lot of bear bars. Bears will start selling with limit orders at prior highs, so they'll sell with a limit order at that high. You have a good-looking bull bar, but it's following two bear bars, and it's at the top of a developing range. You'll have bears selling above that bull bar, betting that the bulls will fail. Up here, we have a doji inside bar after a buy climax. You'll have bears placing a sell limit order at the high of that doji, betting the high one will fail at least enough for a scalp. We have a pretty strong reversal here. Remember, in a trading range in general, you want to buy low, sell high. But when you have a potential trend and you expect lower prices, instead of buying low, you can actually sell low. This is fairly low down, and we have a small double top bear flag with a decent bear bar. Bears will sell below there. And then same here, a low too short and a bear channel. They'll sell below that bear bar. Here, pretty strong reversal down, a low one short. Even though it's in the middle of the range, traders will sell, betting will go at least a little bit lower. Opposite's true for the bulls. Over here, pretty strong two-bar reversal after a double bottom, breaking above the neckline. Bulls will buy the low of that bear bar, betting that the bear reversal attempt will fail and that will go up at least a little bit more. Here, strong breakout, strong follow-through, probably at least a little bit lower. Even though we're in the bottom third of the trading range, traders will sell. They'll sell low, not sell high. In general, traders want to sell high and buy low. That's the best way to trade. More experienced traders, when they see a strong reversal down, they're willing to sell low, sell in the middle half or even the bottom third of the range. The opposite's true with the bulls. When there's a pretty strong leg up, they'll be buying in the middle of the trading range, even though it's easier to buy low. They can enter with stop orders in certain setups, like here we have a double top bear flag with a decent bear bar, and we have a bear reversal. Maybe we'll get a spike and channel down. We did. So they can enter with stop orders, or they can enter with limit orders as well. Strong reversal up, a bear bar, but strong enough reversal for at least a little bit more up. Bulls will buy at the low of that bear bar. When the range is very tight like this, it's better not to trade at all. And if you do trade, it's better to be trading with limit orders, buying below bars at the bottom and selling with limit orders at the top. Also better to be using wide stops, and it's better if you can scale in. And that combination, I think, is too difficult for traders starting out. That's an advanced style of trading. We have a small range here, and we have a bigger range here. You can call the entire screen a range. But let's take a look at this smaller range right here. I say buy low, sell high, and scalp. I mean both bulls and bears are buying low. Both bulls and bears are selling high. When the market's high, bears are selling because it's high in a trading range and breakout attempts will probably fail. And bulls are selling as well. The bulls who bought low are selling high to take profits. At the bottom of a range, the bulls are buying, betting breakouts will fail. So for example, they'll place a limit order to buy at the low of that bar, get filled here, or they'll buy on the reversal up. And guess what? The bears are buying as well. The bears know it's a trading range and the bear breakout will fail. So the bears who sold up here are buying back their shorts for a scalp. At this point, the range is bigger, taller. This is now the upper half, and this is now the lower half. And later, the range gets even bigger, and this is now the upper half. So traders will look to sell up here, and this is now the lower half. So traders are looking to buy down here. Think about it. When both bulls and bears are buying low and selling high and taking quick profits, scalping, the market has to go sideways because every time it goes up, bulls and bears sell. Every time it goes down, both bulls and bears buy. And both are confident that the market's not going to go very far. So they're scalping. When the market goes down, even if it's falling fast, bears are going to take profits and bulls will buy. And when it's racing to the top, bulls will take profits and bears will sell. When a trader sees evidence of a trading range, they should do exactly what the institutions are doing: buy low, sell high, and scalp. Trading ranges tend to have very deep pullbacks after very strong legs. You should be looking to buy in the bottom third. Instead of half, you can go to the bottom third. So here we got a strong leg up, deep pullback. Pretty good rally, deep pullback. Strong leg up, deep pullback. Strong leg down. You can call this a deep pullback from this sell-off. So at this point, here's the upper third of the range. So traders are looking to sell in the upper third, buy in the bottom third. And then as the range grows, it's taller. So the upper third is up here, bottom third is down here. Traders want to buy down here. They want to sell up here. And then later on, the range grows more. This is the upper third. Traders want to sell up here, and traders want to buy down here or on a reversal up as the market dips into that lower third.